Hello everyone, my name is Vikas. Hope you guys are doing great. So today we're going to discuss one of the important questions that's on everybody's mind. Whether Bank of Canada is going to cut the interest rates or remain the interest rates at 5%. So before looking into like whether the Bank of Canada would be cutting the interest rates or keeping it flat, we need to consider what are the data points it will be looking into in order to make this decision, right? That's very important. One of the such most important data point is retail sales growth. The retail sales data which came out last week, which showed absolutely there's no growth in the retail sales. What is it is reflect? Basically, it reflects consumer confidence. The general consumer doesn't have much confidence in the economy, and they're not spending too much money. They want to save money because if you see what is the basic major expense for any household, it's a mortgage, right? If you see 2 to 3 years back, during the COVID or pre-COVID, the interest rates were hovering around like 2 to 3%, and people who were logged in for those interest rates had to refinance right now, and the current interest rates are hovering around like 6 to 7%. Fixed are coming around like 5% or something, which is almost the double what the interest rates were 2 to 3 years back, which leaves a big dent into the household income, right? They don't have enough money to spend because most of it's going through the mortgage. Well, the retail sales data not only reflect the consumer confidence, but it also affects the businesses and the economic growth. If the consumer is not spending, there's no much money in the business. The business also eventually cut down, and which eventually leads to unemployment rate increasing. So basically, it's a domino effect. If one falls, rest everything falls as well. And the second most important factor is unemployment. If you see the latest unemployment rate, which came out, which is currently around 6.1%. Pre-COVID, it was hovering around like low fives, around like 5.1 to 5.2%. And in the last year, like 2022, 2023, it's around like 5%. Right now, it's an increase of almost one to more than 1% in the unemployment rate, which is not a good sign, which puts an upward pressure on the Bank of Canada to reduce the interest rates. And the third most important factor is inflation. Well, the inflation in the March reading, it came up 2.9%. It's a slight tick up when compared to the Feb data, Feb report, which was around 2.8%. So inflation is not coming down quite. It just came. It came drastically from 5% to 4% to right now it's around like 3%. But it's nowhere near to the Bank of Canada's target of 2%, right? Well, coming 5% to 3% is okay, but coming from 3% to 2% needs a lot of effort. So you may have a question, right? Well, the business growth and the economic growth is falling down, and the unemployment is ticking up. What makes the inflation not fall down? It's still kind of sticking around like 3%, or sometimes it's sticking up. So why it's not been decreasing? That's a great question. Yes, the inflation is correlated to the economic growth as well as the unemployment rate, but that's not those are not the only factors that affect it. There's also external factors like crude oil. If you see the currently crude oil prices are hovering around like $82 per barrel. This is mainly because of the production cuts that happened because of the OPEC nations that announced huge oil production cuts starting of 2024. And there's also supply chain disruptions that happen because of the Ukraine war, as well as the Iran having its influence in the Red Sea. And one of the major other factor that is contributing to the rise of the inflation is the housing. Um, housing weighs housing weighs around like 30% in the CPI inflation report. It has a weightage of 30%. Even though if you see from past few months, the rental rates have been flattened. It's not been rising so much. But the same would be not reflected into the CPI inflation report because housing usually is a lagging indicator. It has data from past 7 to 8 months back. So going forward, you would see the inflation coming down as well. One of the other most important factors is the US economy. Even though Canadian economic growth is being falling down, the inflation is coming down, the same is not being happening in the US. In the US, economic growth is still strong. Inflation is growing a little higher. Because of this, the Fed's gonna delay its interest rates, right? Cut down of the interest rates. The Bank of Canada usually follows Fed interest rate decisions. Bank of Canada can raise the interest rates before even Fed rising the interest rates, but it can't drop the interest rates because of the capital inflow that takes place because of the differential in the interest rates. So Bank of Canada would be usually waiting for the Fed. It'll be waiting for what the Fed would be taking action on the interest rates. Basically, it'll look into it. So basically considering all these factors, yes, the economy is declining. The unemployment is ticking up. But the inflation is still hovering around 3%. It's nowhere near the target of 2%. And the federal rates, Fed is also not very keen on downgrading its interest rates, at least coming couple of months. So according to my analysis, I think the Bank of Canada would be waiting. There is still a 30% chance, make no mistake, there's still a 30% chance that the Fed, the Bank of Canada would be cutting the interest rate this coming June. But mostly it's 70% it's not going to happen. We got to still wait for some time. At least I'm expecting around like end of this year, around like August, September, maybe that's the time when the Bank of Canada would be starting to consider the interest rates. Well, what all this would impact the housing? Yes, when the interest rates cuts happen, yes, there would be a surge in the economic activity in the housing. There will be demand in the housing, but don't expect a crazy growth that people have seen during the COVID times, right? That's not going to happen. There would be a balanced market. The good properties we're going to sell quickly. Anything which generates good cash flow, but the bad property is going to still sell. It will be a balanced market. I wouldn't see just because of interest rates cut that is happening, and the Bank of Canada would be very careful in cutting the interest rates. It doesn't want the rental market to go up and the housing prices to go up, right? So it'll be gradually looking into each and every factors. It'll make a careful decision so it doesn't jump quickly because they don't want to flip flop on the interest rates. So once they can't go back again. If you're planning to purchase a home or refinance a home or just looking for a pre-approval, don't hesitate to call me on my phone number, which is provided in the description. Thank you so much.